Most of my founders who have done an incredible job, have had good exits or growing really quickly, they are the people who, no matter what time of day I message them or on a weekend or whenever, 10 minutes later, 20 minutes later, 30 minutes later, they are giving me a message back, right? And I operate the same way.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Rob, thank you so much for joining me today. Super excited to chat with you. All right, Rob, you were a general partner at Dragonfly Capital, one of the largest digital asset funds with over $4 billion in AUM. You focus primarily on venture. Previously, you worked at GoldenTree Asset Management, PJT Partners, Heritage Group, and Goldman. All right, Rob. So it looked like at around 2018, 2021, you were at PJT Partners. And I think that, within that, this is going from your LinkedIn, it said you were in fintech and digital assets and a few other things. Is that when you first discovered digital assets, or did you discover digital assets way before that?
So it was actually earlier. Actually, the very, somewhat interesting story, I guess. I was at Goldman early in my career. So I was there from 2013 through 2016. And, I was an analyst, I was working really hard, and I was mostly focused on fintech. But one of the things that happened during that period of time was that there actually started to be some interest in Bitcoin. People don't know this, or maybe they remember this, but there was some interest in Bitcoin at the large banks in going into 2015. And the reason for that was, and I think I'm gonna misquote this, but Bitcoin hit like $300, and then it kind of got close to $3,000 at one point there. And there was actually a lot of conversation about blockchains. And so I don't know if you remember this, but Blythe Masters, who was at JP Morgan, actually was on the front. It was either like, I think Bloomberg Business Week, and there was a headline that was "Blockchains, not Bitcoin." And there was all this conversation at that time around how like blockchains were going to reinvent just like how digital assets or financial services ran on blockchain rails. And it was during that period of time that a lot of people in my seat and a lot of people at these banks started to think about Bitcoin and crypto and things like that. And so Goldman actually invested in something during that time called Axani, which was essentially the first tokenized high yield credit platform on chain. And so this is like not a new conversation that we're having today about tokenized RWAs. That was a conversation that was happening. This business, Axani, was founded in 2014. And so one of the things that we did at the time is that we put together a kind of a working group to talk about, okay, like what should we be doing? Should we be offering Bitcoin to our clients? Should we be investing in things like Axani? Is there a real use case for tokenized assets? And I raised my hand and said, hey, listen, this is actually something that's interesting. I've been reading about it. Like I knew people in college who had, bought some Bitcoin and things like that. And so it was actually during that time at Goldman that I first got interested in it. But it wasn't until later when we went from, call it, Bitcoin to like a much broader set of applications that could exist on with smart contracts and on Ethereum that I actually got like really into crypto.
So yeah, tell me about the evolution, because my own evolution was heard about Bitcoin in 2013, bought it, and then it crashed, and I sold it all. And I was like, Bitcoin's a scam, but blockchain's a real deal. So there's many years where all the way till 16, I was like, I'm a blockchain guy. I don't believe in Bitcoin. And then of course now it's flipped since then. But was your evolution more of like, this is incredible technology that we need to utilize, or was it, I can see how Bitcoin makes sense as a non-sovereign store of value? Like, tell me about your evolution.
So you sounded like everybody I worked with, which was like, yeah, like, Bitcoin doesn't really make sense, but why does it have any value? But blockchains make sense. I would say I wasn't there, but I didn't really get Bitcoin in the same way. It took me years, I think, to really understand Bitcoin specifically and why it should and why it does have value. And so I was interested in it. I actually bought it in 2013 as well, and it crashed. And similarly, as a young kid, and I was like, oh, like this is terrible. This is like, all this like little bit of money that I have. And it did put me off, I think, Bitcoin specifically for a little bit. But I found the conversation around digital money to be incredibly interesting. And this was at a time when I was working a lot on things like consumer fintech generally. And so like it just made sense within the world of how I was thinking about my career and where there could be an evolution of finance. And especially in, I grew up in a part of the Midwest that was not, extraordinarily well off. There's a lot of people who were, call it insecure in their financial situation. And in that part in the US and in that part of the Midwest, it's still very different than, call it like the global South. But it got me thinking about the global South and people who, had, were potentially like, insecure about their monetary situation. And that did make sense to me. And I saw a lot of people at this time investing in like African fintech. And I could see like why there was, kind of that link. But then when Ethereum and the ICO happened, and there started to be a conversation in, call it the late 2010s, around DeFi, right? And there was Basis Cash, which was super interesting, and then there was there were seed rounds for a lot of for Compound and for a lot of these like DeFi protocols, and that was like, oh wow, like this really changes everything. Then this changes everything that I know and that I've worked on in my career. And that was what got me wanting to go kind of that extra step between like, oh, this is something I kind of think about and I think is interesting to, like, I need to dedicate like my career to this.
Yeah. So at PJT, you're saying Basis Cash and Compound and whatnot. You're at PJT, I think it was 19 to 21 or something around that. That was when those protocols or platforms were launching. Were you talking to the folks at PJT saying, hey, we need to get involved here? Or was that coming from you or coming from them? Because isn't PJT a large private equity firm?
So PJT is mostly basically like a merchant bank. They do mostly advisory side, but also investing. So a little bit of everything. So I was like known as a person there that like really liked crypto. And you might remember, obviously, the run up to Bitcoin going to 19K in 2017. That was when, there's a conversation started again where everybody was like, oh, listen, like we need to pay attention to Bitcoin. And, I looked around and I said, hey, listen, like I'm actually very interested in this. I was involved in the first iteration of the blockchain club at Columbia during that period of time as well, because I'd gone back to business school. And I just talked about it a little bit. And so it wasn't that it was driven by them, but they kind of knew that like, oh, I was the weird like crypto guy over here. But at the same time, I was still doing a bunch of traditional fintech stuff. And actually I was looking at a lot of payments at the time. And that's how I got a lot of the knowledge I have today about how payments work. But one of the things that started happening is that we had a lot of very large Fortune 500 fintech clients. People like, PayPal or Franklin Templeton or, call it any number of payments companies, Visa, et cetera, that at that time started to actually think about crypto again, right? And so when Franklin Templeton, for instance, they were one of the first to think about, oh, maybe we should put a money market fund on chain. And I remember what actually happened is they had asked around, like, actually who and these traditional financial firms knows anything about crypto or tokenization. And we actually raised our hand and we said, hey, listen, like I can give a little bit of a teach-in. And Jenny Johnson and I had, one of her first conversations about how could tokenization happen? Like, well, how does it make sense? Like, why would you do it? And how should you do it if you want to? They actually decided, and people may not know this, to put their first money market fund on Stellar, primarily because there weren't smart contracts on Stellar. And they thought the regulators would like that better. And they thought that it was more palatable for people. And so I started to actually have a lot of those conversations. So I was talking to PayPal and I was talking to Franklin Templeton. I was talking to Visa about like, oh, DeFi. And it's like kind of interesting. And then what I was doing, what I think a lot of people were doing, which is on the weekends and nights, I was, doing my own like yield farming and trading and like things like that. That, maybe I wasn't supposed to be doing, but was just like fascinating to me about how it was working.
That's awesome. Okay. Wow. And then at GoldenTree, because after PJT, you went to GoldenTree, just a quick list of the investments that you led is not exhaustive, just a small list, but Anchorage, August Digital, Avalanche, Caruso, Ondo, The Tie. These are insane companies. All right. So how are you able to identify these companies and then also get into those rounds? Because GoldenTree it's not like a crypto native firm. It's not like a Dragonfly where you want them on the cap table necessarily. GoldenTree is a trad firm that had a crypto arm. So tell me about that.
Yeah, the GoldenTree story is actually pretty interesting. So I had met this guy Joe Nagar, who was a partner there, and had been there for a very long period of time. He used to run structured products at Morgan Stanley, and he had gotten a bunch of the firm into actually Algorand early on, and like with like first check in, and the firm and a bunch of the partners because of that had made a lot of money on Algorand. And I met and Joe and he had said, hey, listen, like we've I think there's an opportunity here. We've made money and some stuff we've done in crypto. Would you be interested in coming on and helping me like maybe launch a business? And so I jumped at the chance because by this time it was like DeFi was in full swing and I was doing, I was kind of straddling these two worlds of fintech and crypto. And I was like, I just want to get deeper and getting deeper by helping build this business for a traditional large hedge fund, which 50 billion of AUM, was just a dream come true for me at the time. And we were kind of the first wave of that, like, and maybe the single first one of those like big traditional hedge funds to start doing a decent amount in crypto, from trading to venture to, growth to, yield farming. Even we were like, at one point we were like flipping sandbox land. We were doing everything, right? Which was really fun. But then we were also doing traditional stuff like, like basis trades and things like that. But to answer your question, well, I think the job was actually easier than I expected. And the reason it was easier at that time, and frankly, like much easier than what I do now, was because we were the first that was, a big, like well-known name to come into crypto. People wanted us on the cap table. They thought it gave them legitimacy, and we weren't big checks. We were, follow-ons, and we were, call it a few $100K to a few $1 million at the high end. And it was all partner capital and it was a light lift. And so in that case, it was more about getting us exposure and letting them borrow our credibility, and borrow our expertise and things that like a lot of those people didn't know, right? Like the Ondo folks, incredible founders and Nathan over there, and he came from Goldman, right? And he had also had this kind of institutional background of building, interesting structured products. And that's what the first iteration of Ondo was really kind of like a tranching protocol. And he wanted our expertise because like we also knew that product. And so that was the conversation. And that's the kind of where we got involved mostly during that time at at GoldenTree.
So yeah, tell me about the transition from GoldenTree to Dragonfly. Because, of course, that makes a lot of sense as to why they want you on the cap table, because you guys were the large institutional player, kind of the first one in the space entering crypto in a major way. But at what stage did you start looking at Dragonfly as, okay, I want to make a move here and go full crypto native?
Yeah, it was a bit of an evolution in 21. And I'm sure as you remember, it was just a very, very crazy year. And so I'd actually co-invested with Haseeb on a business called Afrix. And Afrix, people may or may not know, still a portfolio company of Dragonfly's, doing decently, was one of the kind of this first iteration of companies who saw the potential of stablecoins and wanted to solve like cross-border remittance and put it on stablecoin rails. And that was something that had really resonated with me as someone who had been, part of these earlier conversations around like consumer fintech and like what that could mean and what stablecoins and crypto could mean for that. And so I got to know Haseeb a little bit during that period of time. And in early 22, I started to get a little bit of an itch. And that itch was that like, I enjoyed what we were doing at GoldenTree. We were at kind of the forefront of being one of the first big financial institutions to do this business, but also it wasn't clear to me that we were going to go all the way. And I thought we needed to go further. I thought we needed to get deeper into the space. I thought we needed to have a little bit more of a risk on appetite. And we had a big risk on appetite for a fund that size, to really, get the outsized returns, to really get the outsized gains, and to be in the know of everything that's going on. And I just started to feel this itch that I needed to get deeper. At the same time, because I had kind of started this relationship with Haseeb, we weren't close yet. Dragonfly had raised, or was in the process of raising our third fund, which was a $650 million fund. And he reached out, and we started talking about how, well, Dragonfly has got this amazing pedigree in terms of, engineering talent and very crypto native talent. product talent with Tom being, the first PM at 0x. And, but what they didn't necessarily have at the time was, some of the background and knowledge that I had of underwriting traditional assets, of being involved in traditional financial ecosystems and things like fintech, et cetera. And there was an understanding and a foresight, to be honest, by the team, that the world was probably going to go that direction, and that having somebody with that expertise was going to be helpful as well. And so, I got to know Hadick a bit more in early 22, and Tom and Bo. And, they asked me to come on in early 22, and it just felt right. It was clear to me that I wanted to get deeper. They were, already at the place that I wanted to be. And then I could also help bridge the gap between Dragonfly and this traditional world, which was, a wave of, and basically a tidal wave that was coming into the space. And so that was when I decided to come in, and it's been now an awesome, 3 years or so.
Did your investment thesis on this space, or sorry, has your investment thesis on the market or in ecosystem changed since that joining date, 3 years so ago? Was it, okay, this is, going to take over all finance and I need to be in, now, and then now has that expanded? Or just tell me your thesis initially, and how has that evolved for the past 3 or so years?
Yeah, the thesis hasn't really evolved that much, to be honest. What I would say is that my perspective at that time was that traditional finance and crypto were going to collide. That both crypto needed to institutionalize, and that also traditional finance needed blockchain rails, and they needed digital assets to come into basically a new paradigm. And we've been investing on that theme, both from a, call it a market infrastructure perspective, a stablecoin perspective, a CeFi and DeFi intersection perspective for the last 3 years or so. And Dragonfly had done things around that theme before I joined. And the only thing that has changed is I feel more confident now than I did then. But it's still top of mind, and it's still how the number one thing I think about every day when I wake up and I start talking to companies, and I start thinking about, what do I want to back? Who do I want to be involved with?
So, Dragonfly is able to, there's no niche within Dragonfly or subsector that you guys are focused on. It's just all digital assets. What is there a subsector that you specifically love and love to spend your time on? And I know that's kind of a hard question, but if you had to choose.
Yeah, I spend most of my time on the stuff that I'm talking about, right? So I've spent basically my entire career in fintech, or at the intersection of tech and finance, right? And so things like DeFi are just fascinating to me, and that was really my first love in crypto. Things like reinventing, market structure generally for being able to do 24/7 settlement and being able to just improve upon current financial rails, that's really fascinating to me. Stablecoins is something that I write a lot about. I spent a lot of time in payments in my career. That's really fascinating to me. And so I would say those areas where there's call it an intersection of finance and tech are really interesting. And then also the financialization of other markets. So I led an investment into Polymarket, call it a year and a half ago or so, which a lot has happened to that business in that period of time. And they've, kind of proved out this thesis that information markets and financial markets can be a great way to parse information. And we've seen that with, through the election and how it performed, and now through their relationship with X, that's become more clear. But those types of companies and protocols are the ones that really excite me, and the ones that I spend most of my time on.
I have to say, I'm so excited that Polymarket has kind of reached some sort of critical mass here, because I was a fan of Augur back in I think it was 17. And I was like, oh my God, prediction markets are going to be the best things ever. It's going to, we'll be able to tell the future, et cetera, et cetera. And over time, seeing them not succeed made me really kind of bearish on the concept. When I saw Polymarket, I was like, oh, there's just another one of these things. But again, to see them reach, I forget what someone recently posted a number of visits per month, and they're up there with they're below Robinhood and Coinbase, but they're still they're top 5 or something.
Number 3.
So number 3.
No, they're number 3 on the
right.
Yeah.
So super impressive.
Doesn't Kalshi, which is their next biggest true competitor.
Right. And Polymarket on a comparative basis does not market nearly as much as Kalshi markets. I see Kalshi ads everywhere. So it's really, really impressive. So very happy to see that. All right. So when you're looking at a startup, what are the factors that you're first digging into? Of course, you meet the team, you hear the pitch, you understand they're building in, I don't know, for this example, some DeFi, CeFi, fintech protocol or something like that. But what are these factors that you're looking at?
Yeah, so it depends a little bit on stage, and we do true venture, so that's the kind of seed through Series B. The earlier stage, the more soft factors. The later stage, the more call it hard, like quantitative factors. But it's really a mix of a few things. So one, it's who are the founders, and is this? I actually like this concept that Patrick O'Shaughnessy talks about a lot as somebody's life work, and is that something that they seem really passionate about? Is it their life work? Is it somebody who has, a true, call it founder market fit? This is a space they know. Is it something that they have a right to win in, that they are able to be really credible in? And do I think there's someone that can go and convince other people, whether that's hiring or whether it's other investors, to be along with them for the ride, both in good and bad times? And so that founder or the founders is a big part of every decision, whether it's early stage or mid stage, but even more so in the early stage. Then I spend a lot of time on, what the market is that people want to go after. I'm very focused on things that are either net new or things that are, call it a leap forward, not a step forward in terms of making something better. And so, in 21, I remember seeing a lot of investing into, call it like, Uniswap on name your chain, right? And it was just like, listen, like, Uniswap hasn't deployed there yet. We're going to be the first to deploy, et cetera, right? That type of, call it just kind of derivative or incremental type of company or protocol, like that's not something that excites me as a venture investor. That's something that, maybe that ecosystem needs, but it's much harder to get involved with and to see the outcome be what we hope that it will be. I think we're also focused a lot on not just on where they think that they can build like value capture and value accrual. So, one of the things that I've thought a lot about in the stablecoin space, and I've written blogs about this in the past, is, why in the part of the stack that you are building in, should you be able to capture value? And are you thoughtful about that? Do you understand that? Do you know that, this is a place that, should be defensible? And then, if we get later stage, it's a lot of like, okay, what do your traction numbers look like? I want to know, what do your users look like? What does your TVL look like? How many transactions you're doing? I'm going to actually look at the wallets to see like if I think this stuff is like wash trading, or, maybe it's one of your earlier round investors who's actually just, putting money into your protocol. We're going to look at, or at least we try to look at what retention looks like. And we have pretty good ways to, I think, kind of parse out what some like on-chain retention might look like, and have a conversation too around, okay, well, what do we think your cost of acquisition is? What is your LTV of a customer, at least so far? Like, we're going to dig into those numbers. And I think a lot of venture firms in crypto kind of don't do that. And they spend a lot of time on, just like relative value, like, oh, I think you're the X of Y, and, that X trades at this, and so we think you'll trade there. And that's just a losing game in my mind. And so I think those are really the things: the market, the founder, the understanding of, how you create a moat, and then, what the traction looks like. And that's kind of the main places that we were going to spend a lot of our time.
For the founders, how are you able to assess their personality traits? Are you just having multiple conversations with them, doing many background checks, and just getting a picture of who this is as a person? And then you mentioned the lights work, which I absolutely love from Patrick O'Shaughnessy. But how are you able to assess that? Because that is like, of course, it's tough to kind of put a facade up for so many times that you interact. But are they just oozing with passion and it's infectious? Or like, how are you able to be like, oh my gosh, this person is obsessed with this?
Yeah, it's hard. So I think to your point, it's a couple of things. One is, you just have to spend time with them. And I'm a firm believer that you cannot make it a good investment. Well, maybe you can get lucky, but you cannot repeatedly make a good investment by only doing things on Zoom. Like, you have to go and meet somebody in person. You have to go to their office or their home or their WeWork. You have to spend like time with them that is unstructured. You have to spend time with them that is like over a meal or, a beer or like something like that. And you'll get to know people pretty well if you do that over a period of time. One of the things that you see happen is that you have these 30-minute calls, these hour-long calls, and they say all the right things, like they're in the mode, right? And then you go and you have a beer with somebody, and you start talking about your life. You start talking about my wife and my dog, and like, where I came from and all those types of things. And they start talking to you. And, I've seen in the past, founders that I was interested in, or that we had potential to want to back, who would then start talking to them about like every part of the conversation was about how they could make as much money as quick as possible. Right. And, it became clear that like, oh, well, this isn't about wanting to build a sustainable business or protocol. What it is about like trying to create, the quick value that I can then, extract. Right. And so I actually think a big part of it is like just have a meal and a beer with them a couple of times and try to let your guard down and try to let them, people like to talk. And so if you, put that space out there to let them share with you, usually they're going to share something. Now, that's not always true. Right. And you do have to do a lot of like talking to, coworkers and talking to, places, people, or places that employed them before. And you have to get some feedback there. That's always a interesting conversation, because what I find is some of the best founders are actually, sometimes they're a little bit abrasive with, old coworkers. And so those old coworkers don't always have the best opinion of them. But if you ask the right questions, they'll tell you like, oh yeah, they're a really hard worker, but I just found them to be a jerk. Well, like if they have a good track record of also hiring people, then you understand that like there's a reason that there was that abrasion there, and that why those people didn't get along. But it doesn't mean that they're not going to be, or it actually might mean they will be a really good leader who people will want to go and die for, right? And so, figuratively, of course. But that's the thing that you really have to spend a lot of time on.
Are there red flags that you've picked up on over the years where you can, if a founder, and you don't have to reveal necessarily what they are, but are there just these things that some founders will say will immediately turn you off? Like, for example, you just mentioned the hey, I'm trying to make as much money as possible, as quickly as possible. Like, obviously that is a red flag, but is there anything else that's more subtle or more, where you're like, man, I've seen this before, and every 5 times out of 5, it's always been this ends poorly, or is it highly variable?
It can be variable, but there are a few things that, kind of you can spot regularly. And a couple of them are things like, you ask detailed questions about like what they're trying to do, and they just never give you detailed answers, right? They clearly haven't thought really deeply about what they're trying to do. If you couple that with somebody who also like name drops a lot, 9 times out of 10, that person is trying to scam you. Like I'm not kidding, maybe 10 times out of 10. And so like they were going to go and maybe they'll be good marketers. Maybe they'll launch a token that'll do well, but like they don't have any desire to build something that is sustainable. And so, I think probably those two things coupled together is the most obvious and repeatable red flag, because I see it a lot, especially from young founders who think that this is like a fast and loose industry and they can make money and they can leave really quickly. And so that's something that we see a lot. I think beyond that, people who spend a lot of time like talking about like, oh, what someone else, or like what like this other VC is doing, and they at least this is my perspective, and maybe they're learning this lesson from other VCs. But they're like, oh, this other VC said they're going to come in and they're going to give me a term sheet and they're going to do it X amount or et cetera. I think they're kind of or at least like they feel as if their incentive is to like try to create the competition versus trying to convince me why their business is great and their protocol is great and why they're the great founders. And that's something that, maybe works with some VCs, but it doesn't really work with us. Right. And so I don't want to hear what you think the VC wants to hear. And we also see this when people talk about their protocol, or they'll be like, oh, like, AI agent / stablecoin / whatever else the hot thing is / and like this is, and it's like a word salad, and it's like, oh well, this is like what I think all the VCs want to hear. And it's like, no, like, well, like, what are you doing? What problem are you solving? How are you solving the problem? How is that going to create value? And convince me like that this is something that you're passionate about, not whatever you think the VCs want to hear.
Alternatively, green flags, because we're talking about having a beer with them, hanging out with them, and just really getting to know them as people. Are you looking just for this undeniable passion, or like, how do you identify these things that are so qualitative?
I'll say, so one very specific point, and I think some people would be mad about this, but how quickly somebody responds to a Telegram message or an email is always a good sign of whether or not they actually really want to work on this thing, right? And I will tell you, most of my founders who have done an incredible job, have had good exits or are growing really quickly, they are the people who, no matter what time of day I message them or on a weekend or whenever, 10 minutes later, 20 minutes later, 30 minutes later, they are giving me a message back, right? And I operate the same way. And so to much to my wife's chagrin, like, Saturday at 5 p.m., like if I get a message on Telegram, I'm responding to it. And 9 times out of 10, if it's somebody that, I already know and I'm doing business with, et cetera, and the founders who do that are also the ones that, like, you can just know, like, this is their life's work. They are not going to try to lose. And so, being that online, unfortunately, is actually a big sign of somebody who, like, really wants to do a good job. I think, beyond that, it's people who spend a lot of time talking about like who they are and like what drives them. People are like really introspective. I find to be much better at, pivoting and figuring out when things are going wrong and are figuring out, when maybe they haven't done the right thing in this part of the business. And so they need to refocus on that. And then they need to move to the other part of the business. And so introspection is actually one of the traits that I care a lot about when we're doing a deal. Then lastly is just, if they've hired people before, that everybody who worked for them before will say some form of like, oh, they were a tough boss, but like I will, like, every day, like they made me want to like run into that wall. Like I wanted to go to war with them. Because that is honestly one of the CEO's biggest and most important jobs. It's just being to hire a great team that is better than they are, and that can, hopefully take that business to the next level.
Are there things that is there a reoccurring theme you see with founders within the Web3 ecosystem where they're underestimating some aspect of the business that they think is easy? Like, I don't know, like, for example, like, oh, we're going to build this and we're going to go just easily acquire users. And it turns out user acquisition is really hard. Or like, what is the thing that users are still underestimating today?
Founders are definitely underestimating that like tech is not necessarily a differentiator in most cases and in most protocols, right? So we're at a point in time now where for most things, tech is a threshold. If you get over that threshold, then like, the rest, the other 20%, like it's all about distribution. It's all about go to market. It's all about product, right? It's not core tech, but it's like, can I build a better user experience? And creating a better user experience is actually much harder, I think, than people realize. Like if we look at things like, Athena, for instance, right? Athena as a protocol was not that different, but different in the right ways from things that existed before. There was UXD protocol before. It was a basis, trade, stablecoin before, right? But what they had this insight into was that, scaling needed to happen with centralized exchanges, not with decentralized exchanges, because that's where most of the open interest lied. And they needed to align incentives with, those centralized exchanges and market makers and trading firms. And then they needed to be able to have a product that had, call it off-exchange settlement, so that they didn't have that, counterparty risk. And we saw this, perform extremely well with during the Bybit hack. And so that was slight product changes that then, alongside them being able to build the right partnerships with people like Pendle to be able to speculate on, kind of the upside of the protocol, the same way of getting yield, and that distribution and go-to-market game, like that's what Guy really solved. And that's why Athena did, such an incredible job when, people before didn't quite have that product insight and that partnership insight about how to go and turn this into something that was really, really big. And I think we see the same thing with, things like Hyperliquid, right? Like there's not that much technical differentiation in Hyperliquid. There was some very small product decision points around how they think about, transaction priority and like how they think about, cross collateral and margining that like made it a better experience for people, but it's not that different from things that have existed before. And I find often that those are the things that are kind of under thought about, whereas, and it's like, oh, well, I'm just going to have like, better block times or, something like that. As if, being slightly quicker than Solana is the thing that will make people want to use your chain today.
Man, I love you said that. Like it's so funny because like you say that to any engineer in crypto, they're going to be like, those are fighting words. Like, what do you mean the tech it doesn't differentiate? And so in terms of distribution, like, I guess by its nature, distribution it should be novel in order for it to be very effective. But is there a pathway, or is there some sort of roadmap that founders can use in order to get greater distribution? Or is it literally just like, no, you got to come up with some new system that is very inventive and people like and haven't seen before?
I don't know if there's call it like a playbook, right? And if there was, there'd be a lot more people doing it, and then there would have to be some other differentiation, right? What I think there is there's really good founders who understand positioning, who understand how to sell themselves, who understand what their customers want, and who are extremely customer led. And so, if those people who are talking to and have a lot of passion for what the customer wants, which is, in this case, maybe it's a DeFi trader, maybe it's a whale depositor, maybe it's, kind of a broad set of retail users and things like Polymarket. But they have this obsession about what the customer wants. They'll figure out a way to create and to refine the product and then distribute it to those users, right? And to those people who are kind of their core, kind of maybe the core protocol user. And so that's the thing that I really think is important, is that you have founder-led product and sales. And if founder-led product and sales, and you have that obsessive, life's work mentality, like we talked about earlier, that is what I think usually ends up, kind of busting through. And because those people will figure out, how they can best structure that business, and then people will want to partner with them. People will want to work with them because that mentality, that grit, is infectious. And so it's really, at least in my opinion, in crypto, because it is so much easier to get like a DeFi protocol to market. It's really about how that founder can position and how that founder can grow, from his mentality and grit, or her mentality and grit themselves.
What is your take on the token markets? Because obviously tokens are the most unique aspect of crypto by far, and definitely the biggest differentiator between a traditional company and a crypto company. What is your take on tokens? Do you only invest in companies that will have a token, or plan on having a token, or what is your stance?
So we do both. We've probably got, call it like 30% of the portfolio that is equity only. So, no token component whatsoever. These are mostly exchanges, kind of traditional like brokerages, stablecoin companies. And we have a couple like, data companies that are, kind of like SaaS businesses, wallets, things like that, right? But about 70% of the portfolio has, some sort of token component too. I think what's become, if maybe I back up for a little bit, if you look at the past, there was this assumption that, tokens were actually the best way to get returns, right? And you had, things that would trade, especially if it were like an L1 premia, that they would trade, really high relative to the fundamental metrics, that they, hopefully there would be, continue to be demand for, those tokens, that you had the quicker liquidity. And if you put those two things together, there's an expectation that this is the reason to be investing in this asset class. I think it's pretty clear now that, that's not necessarily true. Tokens have a lot of utility if they're used the right way, and if they're used to align incentives, if they're used to get people to participate in a network, if they're used to reward people for being an early user or an adopter, they can be great tools, and they can be great ways to return capital to that end consumer and that end investor. But it's not necessarily true that it is a great tool if it's not used appropriately, and it's not necessarily true that today that you're not going to get great returns if you just invest in, call it the best, name your, equity business, right? And I think there's starting to be more, protocols that could theoretically have both equity and token value. Like, I mentioned Polymarket earlier. Like, let's say that they actually did launch a token someday. Like, it's very clear that there are ways of which, or, BNB is a good example of this. There are ways in which there's then potential for the exchange to have token value, and to put value into that token and into the equity itself. Now, I think we've also seen on the equity side, the M&A markets picked back up. I guess the IPO market is just like the window's completely open with Circle and with some of the fintech IPOs we've seen. So I think there's a real ability to get return on an equity only business as well. So I think it's more about finding those right founders and those right companies or protocols that are going to build something sustainable for the long run, and not being focused on these like early liquidity events that what we've seen today in a lot of cases have just been kind of straight down because there hasn't been that focus on building sustainable product that people want to use over a long period of time.
So yeah, because I want to ask you about token design, but what you're saying is essentially that the product design is obviously number one by far, and but so of course you have to build a great product, but then if the token is designed incorrectly, or purposely or not purposely, then that could cause a huge issue with the product itself, and of course with the token value accrual. So I guess, in your opinion, what is the ideal? Let's pretend the product works great. What is the ideal token design? And I know that's a broad question because they can be used for anything, but like in your opinion.
Yeah, it's a tough question to answer because obviously I think it's like depends on the protocol, right? You look at things to your point like Helium, right? Helium is growing quickly. They're building this both this kind of like data offload network where you can use the Helium hotspots, but then they also have their own MBNMO here in the US that is growing. But if you remember back to 2021, there was a lot of excitement for that business, but what that led to, because of the inflation schedule, was that there was so much buying of these hotspots and there was so much inflation happening because of that the token just could not catch a bid. It was like kind of down only for a period of time. And that created a concern and consternation within like the token holders and the retail users, et cetera, around holding that token. And it was, I think, actually detrimental, and I'm probably going to get some hate mail now, but detrimental to the growth of the protocol for a period of time anyways, right? And so that's an example of what I think was a really cool product that was hampered by what was probably a poor initial token design, right? But that doesn't mean all DePIN models are incorrect. You just need to have a token model that isn't so focused, and I think this is true across not just DePIN, but across all protocols. If you can't be so focused on just a high initial inflation with the idea around incentivizing those first users, because when that goes away, if you haven't built that flywheel, you haven't built that product that's both on the demand and the supply side, that capital is mercenary. And the one thing we've definitely learned in crypto over and over is capital is mercenary, and people will leave if you're not product led and you're token led, right? And so I think that doesn't fully answer your question, but I think the point being here is that the token design needs to be, one, thoughtful about the long term. It needs to be, two, not just about giving a bunch of money and free money essentially to call it the early users. It needs to be more around how you can sustain and how you can incentivize sustained users, right? And then it needs to be, I think, a lot more thoughtful around, depending on the protocol, creating demand and not just incentivizing supply, right? Because I think, it is a flywheel, right? Like, if I think about a trading firm, right, the traders won't come and they won't have a better product if there's no liquidity. But if the people who are like selling the liquidity, the market makers essentially, they will come if they are traders, right? And so you have to figure out who comes first. But I think at the end of the day, that actually incentivizing call it the makers is much easier conversation than incentivizing the takers, who mostly just want a better product. And then in the case of Hyperliquid, if you make them rich as well, they're going to go to war for you. But I think that was a long-term perspective that they took, not just a focus on what call it that first like season looked like.
Yeah. Okay. So do you think so? Number one, tokens are used as incentive mechanisms for a certain behavior that you want to encourage. But number two, do you believe tokens are going to turn into a mechanism for companies that wouldn't be able to traditionally IPO to be able to like quasi IPO, like Hyperliquid or Binance, for example? Like, those are difficult businesses to IPO for certain reasons. And so, is this going to be a more viable path going forward, or do you think with regulatory clarity, no, we're just going to like figure out how to get Circles and Binances and Hyperliquid to traditionally IPO?
Yeah, so I absolutely think like IPOs are coming on chain in some way or another. What it exactly looks like and how people want to, bifurcate between like the NASDAQ and being on chain. I think we're still in kind of a wait and see mode. I think there's Superstate announced something they're calling opening bell a couple months ago. And the focus there was really around, okay, we're still doing like a regulated, initial public offering, but doing it for kind of earlier stage companies on somewhat of a lighter kind of Form 40. That's not, kind of the full S1, and, being able to, kind of tokenize your equity and reach different customer base there. And I think that's pretty interesting. And I think we will see some of that happening. I think you're definitely going to see it from the crypto native companies. I think you're going to see, Kraken and Coinbase and, all of the exchanges do something like that. One of the things that I think has to be true, though, is it has to be a primary offering for it to be particularly interesting. And so, right now, the version of equities on chain we've seen has been, okay, well, it's issued on NASDAQ, and then, some company will, buy some of these equity and they'll put it into a wrapper, and they will be the actual holder legally of that equity. They will be the ones that have to vote. They will be the ones that receive dividends, et cetera. And then they'll essentially, through an oracle, allow you to trade, this equity that you don't actually have like a legal right to, right? That's what's happening in most of the cases of equities on chain. In that case, all of the price discovery is happening off chain, and you are just following or being, privy to what that market looks like, right? What I think becomes really interesting is, okay, let's say that Coinbase decides that they're going to issue 90% of their float on NASDAQ, and they're going to issue 10% on, name your blockchain, right? And in Coinbase's case, I'm sure it would be Base, right? And so in that case, now you have two primary markets that are disconnected from each other. They can trade at discounts or premiums to each other. They will trade at different times because NASDAQ is going to go to 24/5, but they're not going to go to 24/7. They could have different people interacting who, maybe the people who are trading the equity don't have the piping or don't feel as comfortable being on chain, right? And now what you'll see is you'll actually see a market that is able to build interesting financial products and derivatives that are different between the two, and the pricing will be different between the two. And now you'll see what I believe to be a really robust excitement around interacting with that equity on chain, which I think is just not really there so far in these kind of like, call it Oracle-based like equities, tracking markets.
Yeah, what do you expect the market the IPO market to within crypto specifically? Are we just going to have a full-on bonanza here over the next 6 to 12 months, or what are you thinking?
It seems like we're probably going to have quite a lot of people go and file. I mean, the IPO market is just like
starved.
Yeah, it's the last 3 years. So if I take 22 through 24, the amount or the capital raised in IPOs was less in those 3 years combined than 2020, not even 2021. Wow. And the amount in those 3 years combined was only 40% of 21. So you can see that there's basically been this 3 years of like the IPO market being completely shut. Now that window is open. It started with CoreWeave, which obviously was originally an Ethereum miner and now has this AI story. And then we saw obviously like Circle. I think last time I looked this morning, it was $160, $30 billion market cap, just like continues to just like absolutely rip.
Sorry to cut you off, but what's incredible about that is Coinbase and Ripple were trying to make an acquisition at like 5 to 6 billion just right before that. So it's just crazy.
Yeah, crazy, right? And I don't think anybody expected this. Like maybe Jeremy did, but I never talked to anybody outside of being within Circle that expected that kind of reception that it's gotten here. But even like yesterday, or not yesterday, but on Friday or Thursday, Chime started trading, was up like 60% on day one. eToro recently is doing pretty well. And so it's clear that the market wants these growth stories, right? And so I expect we'll start to see a lot of companies who look like things that are already trading well. So all the exchanges who, have the audits done, who have the right, governance, that are SOC 2 compliant, that have done all the things they need to do. All those exchanges are probably going to try to rush out to market. Everything from like an Uphold, who I think has either they've confidentially filed or there's been, reports that they have through like, probably, maybe like an OKX who has come into the US recently, or, and everything in between, really. And so Kraken obviously has talked about it, Gemini has talked about it, et cetera. I also think you'll see, some of the other brokerages, maybe, eventually something like, call it a Falcon X, and which raised at a big valuation before, probably, or potentially other like stablecoin linked companies will as well. I mean, like Fireblocks is trying to pitch themselves and position themselves as like, infrastructure for payments. And I think we'll see a lot of that. And so all of those things kind of look like, companies that are already trading well. There is this kind of long tail of people who I know want to be public, who are frankly smaller than what the public markets would typically be able to bear. And so, people who are doing, call it $100-200 million of revenue, who, maybe aren't first in anything that they are doing and that are growing, but maybe not growing, that well. Those types of companies typically, like, they just don't trade that well. There's usually, like, if you're not covered by sell side analysts, it's just harder to catch a bid. You're not into, any, sort of ETF or index. And so that becomes, pretty tough. But people, look at what's happening in the market and they're saying, okay, well, maybe I'll be okay because maybe there's demand for crypto. Maybe there's demand for, stable coins or something else. So I think we'll see kind of a long tail of people try to come out. But I don't expect them all to trade the way the things that recently have traded. And I expect that actually to happen pretty quickly. And at some point, and, call it a year from now, we'll be saying, okay, well, this person probably shouldn't have IPO'd.
Interesting. Okay. So what do you expect going forward in the sense of, so one, I don't know. I don't know if it's a fear, but one, it is kind of a fear for me. I'm not sure why, but I feel like the TradFi players like Robinhood, et cetera, these folks are going to actually end up taking over control of most of crypto. Not taking over control, I should say, just taking over more mind share, and just a lot of the winnings, so to speak, are going to go to these TradFi players. When I'm like, man, me and all my friends have been grinding so hard in crypto for so long, like we're going to end up being like a plugin in like Robinhood's grand plans or whatever, right? They're just going to buy us or, acquire and plug it in. Which, not a bad thing for venture investors like ourselves, but it just makes me be like, man, I was hoping that we would get a big stable of all these friends and folks that we know become the next Goldmans, become the next GoldenTrees, et cetera. But I'm like, man, the way it's turning out, I think it's going to be the TradFi players are going to gobble everything up. What are your thoughts?
I don't think that's necessarily true. I get why people think that, especially in Robinhood's case. I mean, Robinhood probably, growing quicker in terms of, crypto mind share than just about any company at the moment. But I just do see like a broad convergence, right? And so I think something that's pretty interesting, right, is that if you look at Kraken, right, they acquired NinjaTrader. Like, what does NinjaTrader get them? Like, they're going to offer non-crypto trading, right? And they're trying to figure out a way to be kind of a platform for everything. And they started with the crypto natives, right? I think, Coinbase, we're probably going to see something, very similar happen as well. And we're going to see a lot more of those two people just kind of come together. I do think it is easier, of course, if you have Robinhood's distribution already to come into this market versus, vice versa, right? But I don't think it's impossible. But I think when you start going from just trading to other use cases, it actually becomes much easier, or I think there's much more of a moat in terms of being crypto native first. And the reason I say that is that trading is, kind of the easy thing, right? And it's like you don't really get, or at least in the ways that, you trade with like a Robinhood, you don't really get the benefits of being on chain, at least today, and the way that, you still do PFOF, et cetera. But when it comes to like call it other assets, there's stablecoin payments, for instance, right? We're seeing this happen with Stripe, and I think Stripe is going to be obviously a big player, but they need to go more and more on chain to be able to get the full benefit of, why using a stablecoin is actually better than traditional rails, right? And so that's why they are acquiring things like, Privy and Bridge and others, because they can't just like plug it into their existing ecosystem. Now, maybe other people will do the same thing that they're doing, which is they'll acquire a bunch of companies, but that means a bunch of people that you and I know will become a lot richer, which I guess is great. But they realize that like they can't just like build it, right? Whereas Robinhood has been just like building it. right? And you go even a step further and you say, okay, well, like, what about credit? What about, any sort of like other type of, call it tokenized asset class that we want to be on chain? And then why do we think being on chain is better? Well, we think that's better because you can actually do atomic swaps. You can actually do atomic settlement. You can create derivatives that you couldn't create or transact against outside of crypto. You can do and you have transparency. You have, things like auto liquidations that can't exist elsewhere, right? And you start to think about, okay, what are the things that DeFi can do that make markets more efficient and better? And you realize that like you actually do have to have more of this crypto native understanding and technology, and not just like, okay, well, I'm gonna go long, fart coin on Robinhood, right? And so I think when the world is reinvented on new financial rails, it is actually going to require a lot of these, crypto natives and crypto native protocols and companies and founders.
You're making me feel a lot safer. I feel better. Thank you. All right. So stables. I mean, this is like, the biggest, one of the biggest opportunities. Of course, there's maybe big opportunities in crypto, but this is one of the biggest. You've written about this extensively. How is this going to play out? Because there's a million different companies, there's a million different opportunities, a million different ways of architecture of the, this is designed this way and this is algorithmic, blah, blah, blah. How does this market end up playing out?
Yeah. So I'm going to actually, probably between when we're recording this and when you put this out, I'm going to drop a blog post about this specifically. But I mean, let's use Stripe as an example again, right? And so, what is Stripe today? They're a PSP or PayFac, which is payment service provider. What do? They help the merchant essentially do everything that they need to do to accept card payments, right? Primarily and other things. And so everything from they're the processor, they're the gateway, they're the merchant account, and then they do all of these other things, right? And you can utilizing a lead bank, you can issue a card, you can do, and then they can provide streaming credit, and they can do all this stuff, right? And they're kind of in this one part of what is a traditional, call it like payment stack, right? Which we call the 4-party model, typically when it comes to cards, right? But then you have like the card issuer, or the issuing bank. You have, they don't always have to be the kind of the merchant acquirer, the merchant bank. You have the card network itself, Visa or MasterCard. And then you have a bunch of other people that, I'm really simplifying here, but, what's essentially happened is that you had this model of 4-party payments and the modern payment stack that happened when cards got invented, call it, 60, 70 years ago. That has, and all the digitization and all the innovation has happened on top of that, which has essentially been because the banks were entrenched. It's all been about how do we kind of connect the banks to the rest of the market better. Well, let's talk about a market where now the central bank is actually the stablecoin issuer, right? And you don't necessarily now need call it a bank to be part of that payment model anymore, right? And you essentially, and if you do that, you also don't necessarily need the network, right? Because, okay, well, why do I need Visa, right? Visa does the settlement of funds. They do all of the essentially orchestration of information from a bunch of different parties, of which the information is all different and needs to be reconciled, right? If all of this happens on a blockchain, then you don't actually necessarily need that. And anybody who interacts with a blockchain, can be the gateway and the processor and the acquiring bank. And so it basically looks like everything is a book transfer, right? Within a same book, right? Or a same company, right? And so I think that the payments model is going to collapse on itself. And I think that means that companies like Stripe or a lot of startups are going to be able to use, be one part of that wedge and then offer a full stack solution of payments on a network that is now open and trustless and permissionless, and is not this opaque situation that we're in now that requires a lot of trusted intermediaries to make coordination work, right? Which means more value comes to us, and which means and the consumers, and it means that there is just a lot more interoperability globally, and then there's atomic settlement between other assets that also exist on chain, right? Which you cannot do now in most cases. And so that world plays out, and this is a sci-fi world that like does not exist today, and a bunch of people are going to yell at me about why this doesn't work. And then what's happened is that every stablecoin issuer and every stablecoin orchestrator and every stablecoin, name your type of company that's playing today, they all collapse on each other, and they all end up competing for who can do the hard things, compliance, and who can, deal and understand with, if they need to, the banks, and then who can actually go and distribute and own the customer. Right. And so that's what I think is happening. And that's kind of a broad answer to your point. But I think there will be there's just convergence of people horizontally expanding to own as much of the value chain as possible.
Yeah. I mean, that future you're talking about is kind of the sci-fi utopian future that we've talked about for so long within crypto. Like, oh, the whole world's financial rails are going to be on crypto. It's going to be better, blah, blah, blah. And it's really interesting. Your example of Stripe, it's like they're making this, they're making that alternative system as kind of like, hey, you guys want to use this potentially. And it's, yeah, I guess in that instance though, would you, whoever's closest to the regulators almost, or like the nation state, might win, in the sense of like, if they're on these, and we're going really, really deep here, but like the approved, if you have a central bank digital currency, it's the people who are kind of the approved players, not too dissimilar to how banks operate today, like with the large banks. But I guess in that instance, it's like whoever's closest to that might end up being the winner, or how do you, what is the edge? You mentioned that it's like who can do compliance and all this other stuff, but yeah, is that the ultimate edge, being close to the government officials and compliance and whatnot?
So I don't think it's being close to the government officials, and I'll say this because banks, and I've obviously worked at banks, right, and they're never the quickest mover. Right. And so, we're hearing a lot of them talk about stablecoins today. They've been talking about tokenized deposits for a long time. We started this podcast talking about putting high yield bonds on chain, 10, 11 years ago. Right. And so I don't actually think, like, the banks are just never able to adopt their tech stacks and to be more like thoughtful, or in the long run to be able to innovate in this way. Right. And so we've seen Stripe is an example of like somewhat of an incumbent. They've been around for 15 years or so. That is adopting to this because they understand now how they can create a much bigger value chain, right? And then they can collapse that value chain on itself. But that's about as, incumbent as it gets, honestly, in terms of what we've seen people be able to be thoughtful around this new world. Because this new world tells you, or if it does evolve that way, what ends up happening is that they vulture and cannibalize a lot of the existing business, right? And you have to be comfortable saying that, like, I'm willing to be the first mover in this next thing, even if it means cannibalizing the current existing business. And the incentive is often not there for people, right? So what I think it's going to be is, I think it's going to be the people who are the most thoughtful around how they can use blockchain rails and stablecoin rails to then go and create a better user experience for across the value stack and the payment stack, but do so in a way that is something that you can work with the regulators on. And so, if you look at the Genius Act, right, there's actually it's a great start in terms of a piece of legislation, but there's actually a lot of gray area in terms of like how payments are actually going to work. Right. And there's still a conversation around like, okay, well, how is yield going to work? So yield bearing stablecoins aren't allowed, but what if you do rewards? How will rewards work? Like, is there a way to continue to give back, yield to people? And all of that is going to be done either by rulemaking, or it's going to be done by basically companies getting really big and then saying like, hey, we're doing this and like this should be allowed and we can prove why. Right. And so I expect we'll see a lot of that. And so in my mind, much in the same way that we've seen, decades of things happen in technology, the disruptors are going to be the ones to win. The people who move the quickest are going to be the ones to win. Just the people who move the quickest, who are able to understand, like, where the fault points are, right? And like, how can they get in trouble? And so, I'm really long, like, a lot of the, stablecoin startups, and we're invested in many of them, who I think are going to go and completely just change and reshape this whole market.
Very cool. Wow. Well, first of all, I can't believe it's been an hour. I know we have to jump into the closing questions, unfortunately, but you have to come back on in a few months, and I want to talk more about this evolution, because it's such a deep. Maybe we can discuss your article or something like that. I think it'd be fun to dive really, really deep into an episode dedicated to that, because it's such an interesting sector that's going to radically transform kind of every aspect of business. So, anyways, Rob, thank you. It is time for the closing questions. All right, if you had to tell portfolio companies they have to build on one chain only for the next 3 years, which chain would you suggest?
It really depends on the protocol, right? And so
if you had to just choose one, but let's pretend it's no, actually, I don't want to give any caveats today.
Listen, there are places where there's a lot of liquidity already, right? So for instance, like a Solana, there's a lot of trading happening on Solana. There's a lot of excitement about, what is, what the people who are building on Solana, and, maybe some of the Dragonfly players who are coming there. But, what there isn't there yet today anyways, is there isn't, call it like the TVL and the captive capital that there's on Ethereum, right? And so, when we look at Ethereum, where we've seen, call it like the lending protocols, that's where they've been the most successful, right? Or the people that were required, or the yield farmers, and the people who are looking for, yield type protocols, that they've been the most successful on Ethereum, and that continues to and remains to be true. And so I think it's really about finding who your ICP is, and then figuring out where they are, because that user base on Solana and on Ethereum and on Base is very different, right? And so that's what I would suggest. And so it is really contextual, which I know is a bit of a cop out, but alas, that is my honest answer.
No, I accept. I think that, it makes sense. I asked that because it's hard to answer, because it's use case dependent. So I want to see if I can trick you next time. All right. What is the best investment advice you've ever received?
I would say the best investment advice I ever received was that you need to be convinced to get off your butt and do something, not to do something. And what exactly does that mean? Is if you're ever in a situation where like you're starting from a place of yes and trying to figure out how to say no, you're almost always going to find yourself making bad investments. It's about figuring out and finding that opportunity that just hits you in the face, and that you need to get off your butt and go and do that investment. So that's the thing that I'm always looking for, and being patient is I think the sign of a really good investor.
I think that someone in Silicon Valley says, maybe it's Naval or someone, but they're like, it's either a hell yes or it's a no. It's very black or white, just hell yes or no.
Yep.
Love that. All right. What makes you pessimistic about the future of crypto, and what makes you optimistic about the future of crypto?
All of the crime that has been happening, and I use crime as a, kind of flippantly, because some of it's not crime, it's just unethical. But the amount of, call it like value extraction that we've seen over the last, call it, the entire time we've been in crypto, but over the last, 6 months, things like, Move and other types of protocols, as well as just a lot of like short-termism, that makes it really tough for me, because I am someone who has like a very long view on the way I like to invest, but also on like, what I want to be a part of, and like, what do I want to talk about, right? And so that has made me really pessimistic. And the fact that we haven't yet gotten to a place of self-policing, and that the incentives still seem to be there for, doing these unethical things, that's really been, very, I think, like upsetting, frankly, for me. Trying to fix that and trying to work with others to fix that, but it's slow moving. On the other side, in terms of what makes me optimistic, listen, if you go and you talk to people in the global South about, what their like living situation is, and the ones who found Bitcoin or found, stable coins early on, about how this has like changed their life in terms of just allowing them a store of value, allowing them to transact more freely, allowing them to opt out of maybe a financial system that wasn't working for them. Like, you can't have that conversation with those people and not coming away feeling just like so much better about what we do. And that's why I focus on a lot of those things, and not call it, the things where people are committing crime.
Love that. Is there a piece of content, whether it be a book, a podcast series, a blog of some sort, that had a major impact on you?
Well, what has probably actually had the most impact on me is just, I would say that I actually really like Invest Like the Best. I talked about this with like Patrick O'Shaughnessy before, right? And so this is like maybe not a super, call it original answer, but it's the fact that like you can go and learn from so many different types of investors who have done so many different things, and aggregate all of that information, and then figure out what works for you. That, I think, is actually the thing that one of the things that inspires me the most around, and it helps me create, the frameworks that I invest with, and I'll put a really fine point on this, which is also, I've actually invested across stages in my career, so from seed through all the way through, call it like pre-IPO, and from equity, debt, token, all of it. And what I have found is that breadth of experience for me and the breadth of knowledge from these other people has made me, I think, a more thoughtful investor on no matter where I am than being like really hyper focused on one thing. And so it really seeking out a breadth of knowledge, I think, is the most important thing you can do as an investor.
Love that. I mean, he's the reason why I started podcasting in 2019, so like 6 years ago. So yeah, incredible series. All right, Rob, last question. 10 years from now, where is Rob?
I mean, hopefully, Dragonfly is 10 times bigger than we are now, and we're continue to be what I think is one of the best firms that are investing at this intersection of tech and finance, and that I'm still doing that, and hopefully doing more podcasts with you.
Amazing. All right, Rob, where can people learn more about Dragonfly and find out more about yourself?
So Dragonfly, we're either on Twitter at @Dragonfly_XYZ or at dragonfly.xyz on our website. And for me, my handle on Twitter is @Hadick, which is my last name, M, which is my middle initial.
Amazing. Thank you, sir. Talk soon.
Thank you. It's a lot of fun.